For years, Japan's government bond market was the picture of stability, pinned down by ultra-loose monetary policy from the Bank of Japan. But that's changed dramatically in recent years. Yields have climbed steadily, the curve has steepened, and the ripple effects are being felt across the entire world. JGB yields have been grinding higher across all maturities, lifting from ultra-low levels that defined the yield curve control era post the GFC. The move has been led by longer dated maturities, with the 2s 30s curve steepening as investors demand greater compensation to fund the government long term. The first big factor is Japan's fiscal position. The government hasn't run a surplus since 1990, and this year the deficit is projected to remain around 2.5% of GDP. That pushes Japan's debt to GDP ratio to 237%, by far the highest amongst developed economies. Political uncertainty only adds to the problem. With the LDP losing voter support, fiscal space is extremely limited, yet demands for spending keep on coming. It makes deficit reduction harder to achieve, leaving markets worried about future JGB supply. Demographics are making the challenge worse. Japan's population is aging rapidly, shrinking the taxpayer base while lifting spending on pensions and healthcare. That imbalance locks in persistent deficits and heavy JGB issuance. The second big factor is inflation. Headline, core, and core CPI have all held above the Bank of Japan's 2% target for more than 3 years, forcing a rethink of monetary policy. That shift was made clear in June of 2023, when the BOJ first raised its yield curve control cap. The move accelerated the climb in JGB yields across the curve. But the impact wasn't just local. Because JGBs are the world's second largest bond market, the BOJ's decision was akin to lifting an anchor on global borrowing costs, adding to pressure already building in the United States and Europe. Higher JGB yields also make Japanese bonds more attractive relative to foreign debt. That could reduce appetite for carry trades and keep more capital at home, adding to upside pressure on yields abroad. Looking ahead, markets still expect the BOJ to hike further, with around 1.5 hikes priced by July next year, and a coin toss on whether we see one before the end of this year. Normally, higher short-end rates would cap long-term yields by curbing growth prospects. But in Japan's case, where fiscal worries are a key driver, further hikes could end up pushing long yields even higher. The message is clear. Japan's fiscal strains, demographics, sticky inflation, and the BOJ's retreat from ultra-loose policy have all combined to drive a lasting reset in the JGB curve, with ripple effects for global markets.